Good morning, everyone. Glad you could join us today for our latest edition of our national webinar series. Today's topic is leveraging your real estate IRA with non-recourse loans. My name is Munzer Ghosheh with the Entrust Group. I'm your co-presenter for today's webinar. Before I introduce our special guest, please allow me to read this disclaimer for you. The Entrust Group does not provide investment advice or endorse any products. All information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering any type of investment. So once again, my name is Munzer Ghosheh with the Entrust Group. I'm pleased that you can join us today to learn more about this very intriguing concept, leveraging your real estate IRA with non-recourse loans. Very excited to have Matt Allen with North American Savings Bank join me today. Matt is a nationally recognized speaker and author on the subject of IRA non-recourse loans. He is the co-author of the book titled Leverage Your IRA, Maximize Your Profits with Real Estate. Matt is a director of IRA lending at North American Savings Bank, a nationwide lender of non-recourse loans. So without further ado, Matt Allen.
Munzer, thank you for having me on. I really appreciate the time and always enjoy speaking with your clients about the opportunity to purchase real estate in IRA, and then secondly, how they can also leverage the purchase. So for the listeners out there, depending on how versed you are on self-directed IRAs, you do have the opportunity to buy investment real estate and also leverage it with a loan if you don't have enough to purchase the property outright. So with my presentation, I'm going to go through the process, what you should expect, what are the differences when you buy real estate in an IRA compared to your personal name. So with that, I will move forward with the slides. And the first thing to note is when you purchase real estate within an IRA, so let me backtrack here. When you purchase real estate within an IRA account, it has to be for rental property. You can't purchase real estate and live in that property 6 months out of the year, even a weekend out of the year. That's prohibited by the IRS. So it does have to be for investment purposes only. And you can't rent it out to certain family members. And the rule of thumb is if you go vertically up and down in your family tree, so your parents, grandparents, children, grandchildren, yourself, and your spouse, you can't rent or sell the property to one of those disqualified individuals. And then the third thing to note, when you do buy real estate within an IRA account, all the improvements and repairs and expenses must come from the IRA. So if you need to fix that leaky faucet, it has to come from your IRA account, the funds to repair that. If you need to make a mortgage payment, pay your real estate taxes, hazard insurance, again, all those expenses must come from the entity that is on title. So I just want to go over those important rules for somebody that this might be your first time getting introduced to self-direct IRAs, just to give you a little bit of a background of the major rules that the IRS does have in place. So let's dig into the non-recourse component more. So when you're buying real estate with a self-directed IRA, let me backtrack again. Sorry, I keep double-clicking here on the slides. There's really three ways you can purchase that piece of real estate. One is to purchase it outright. So let's assume you're buying a single-family home for $100,000. You have $120,000 in your IRA account. So at closing, $100,000 will come out of that IRA and go towards the purchase of that asset that will be owned within that IRA account. So it's not considered a distribution, but it's going towards the purchase of that real estate asset. Just like if you do buy stocks of Apple, it would show up in your account. The second option is to partner with another IRA or another investor. So let's assume the same situation, a $100,000 single-family home, but you only have $60,000 in your IRA. Well, you obviously can't purchase it outright with all your IRA funds, but you have another IRA account that you're aware of, and they'd like to invest in real estate also. So the two of you partner. You both have 50% ownership. You're both going to put $50,000 down at closing. And then for the duration of ownership, you each will receive 50% of the rent from the tenants, and then any expenses that have to be paid also have to be split up accordingly based on the percentage ownership on title. The third option is using leverage. If you have a non-recourse loan, or excuse me, you have to use a non-recourse loan if you're by real estate and IRA. So that $100,000 home, you don't have another investor to partner with, and you only have $70,000 in your IRA, you can get a non-recourse loan, and the lender will actually loan those funds directly to your IRA. So we're not lending to you personally, we're lending to the IRA, and again, the IRA is responsible for the payment. So let's go into the details of how you can accomplish this with the leveraging portion. The other two are pretty self-explanatory. And with the remaining slides, to kind of give you an idea, I'm going to go over what are the advantages of using debt financing to buy real estate, how do you get a non-recourse loan, and then what kind of guidelines and parameters should you look for with North American Savings Bank. Now, there are other lenders that offer this type of products, so I'm going to be basing our criteria, or basing the information off of North American Savings Bank IRA non-recourse loan guidelines. And the other lenders you'll find, they also are going to be very similar too, since it is a non-recourse loan product. So we've already discussed this. You don't have enough money in your self-directed IRA to buy a piece of real estate free and clear, so what do? Well, you can acquire a non-recourse loan. And to explain what that is, I'm sure some of you are wondering, okay, you've talked about non-recourse loans. What's the definition? If you purchase a piece of real estate in your personal name and the property goes into foreclosure, most states have a personal guarantee that you sign on the promissory note, where the lender can go after your other assets, whether it's your checking account, savings, automobile. They do have that luxury of going after those assets if they can't recover the loss from the sale of a home in foreclosure. Now with a non-recourse loan, the lender does not have that advantage. They can only take back the property itself. So the property is 100% of the collateral, and there's no recourse against you or the other funds in your retirement account. So they take the property back, they try to sell it, and then whatever they make off of that, that's their bottom line. And you may ask, why a non-recourse loan? Well, the IRS is very specific. I mean, they're kind enough to let us purchase real estate in a retirement plan, but if you are going to use financing, the IRA can't sign that personal guarantee. It can't be used as security for a loan. So that really leaves one option, and that's a non-recourse loan. If you're to walk down the street, talk to Wells Fargo, Bank of America, they aren't going to offer this type of financing, just something they're not comfortable with, not familiar with, and they'll turn you down just because they don't want to get involved. They see it as a niche product probably. There's not enough volume for it. But for ourselves, North American Savings Bank, it is a good fit. And North American Savings Bank, just to give you a little bit of background for those of you not familiar with us, we are a federal savings bank. We're based out of Kansas City, Missouri. We are the top lender on LendingTree. So most of you have probably heard of that website. We've closed over $2 billion in the last couple of years in residential real estate. So we do have a large presence nationwide with residential loans. And then one of our niche products is self-directed IRAs, or lending to self-directed retirement plans. We're publicly traded on NASDAQ under NASB and roughly $1.5 billion in assets. All right, let's get into the bulk of it now as far as what are the advantages of using debt financing with the self-directed IRA. Well, all your net proceeds are going to go back to that IRA tax-free. So that's really why you would look at different asset classes to help build up your portfolio in your retirement plan. So you buy that home, sell it, 5, 6 years later you earn $40,000, well, if that's a Roth IRA, that $40,000 profit goes back in there, and you never have to pay taxes on it when you take it out of that account. So that can be a very, very powerful tool, and to be able to do that with something else besides stocks, bonds, and mutual funds is really enticing to a lot of individuals. Second thing, leveraging allows for larger gains. So if you only have $100,000, well, you could only pay for one $100,000 property and own it free and clear, where you could look at buying 2, possibly 3 units in that retirement plan if you're using non-recourse financing. And then diversification, those of you looking to take control of your financial future, real estate may be what you know best, whether your background professionally as a real estate agent or you just have a lot more experience instead of stocks and bonds, this would be a great avenue for you to help diversify. As far as eligibility for a non-recourse loan, because it is non-recourse, and we explained what that means earlier, a bank's going to require more money down because there is more risk involved. So North American Savings Bank, we require a minimum 30% down on single-family homes, and then 40% down on 2 to 4 units and condominiums, and then also multifamily, which we would classify as 5+ units up to around 12 units. That's where we're going to cap it off, where we just don't lend on anything larger than 12 units. So you can see from this slide, you do have to have a healthy portion down, but again, that's not only for the lender's benefit, it's also to help improve your cash flow requirements, which is something we'll talk about later on. When you purchase real estate in your IRA accounts, you have to make sure that it is titled properly. So you're not buying it in your name, your personal name. It has to be vested in the entity's name, such as the Interest Group Incorporated FBO John Doe IRA. So you want to make sure when you make your offer that you set it up correctly. It's always best to do it up front instead of have to backtrack, and depending on if it's a HUD transaction, sometimes those are a little more challenging to get the revision on the purchase contract. So make sure you do set it up correctly. Let's assume you're going to partner with another IRA with 50% ownership. It would read the Interest Group Incorporated FBO John Doe IRA and undivided 50% interest. And then the remaining portion would be the Interest Group Incorporated FBO Jane Doe IRA and undivided 50% interest. So that's how you would set it up if there are multiple parties on title. Now, we do lend in all 50 states. There are some states that we look at a little bit closer than others. Nevada and Michigan right now, we're really not lending in either of those states. And then some of the states that have been hit by a lot of depreciation, whether it's California, Florida, Arizona, we're still lending in those states. But we might, instead of up to 70%, we might go up to around 60%. Again, it just depends on the situation and the cash flow numbers that we can see. We don't lend outside of the U.S. So those of you looking to buy offshore property, I'm not aware of a lender that will help with that. Most likely you're going to have to pay for that all cash transaction. But again, I haven't heard of anybody that's done that over the years. Processing time frame for a non-recourse loan. One thing to note is that when you're buying real estate in your IRA, Entrust is also going to have to sign off on those closing documents. So let's assume you're in California. Actually, let's assume you're in Missouri, properties in Texas, and Entrust is in California. So the title company is going to, or excuse me, NASB is going to email the closing documents to the title company in Texas. They're going to overnight them to you in Missouri. You're going to read and approve everything, make sure you understand and are comfortable with the numbers. And then you're going to send the package to Entrust in California. And they're going to sign off on all those closing documents and return them to the title company in Texas. And that's when the loan will officially fund. So you can see there's change of hands that you need to plan for. So I would actually add 3 to 4 days extra as far as the closing date that you set up from the very beginning, just because with the changing of hands, you need to allow yourself a little more time, and just depending on the third parties that are involved, it could take an extra 3 to 5 days to get that returned back to the title company. As far as loan programs that are available, we typically offer a 5-year ARM, 15-year fixed, and then a 20-year fixed. And let me get to the correct slide on that. So all of our payments are going to be principal and interest payments. And to give you an idea where current rates are right now, the ARM starts at 5 7/8, and the fixed product is going to be somewhere in the 6s, and at the high end it would be in the low 7s. And again, that's depending on the situation and what kind of property it is. We do have a minimum of $50,000, but occasionally we will go a little bit lower than that if the situation is right. But we typically market at around $50,000 is the minimum threshold. Now, for some of you that already own real estate in your IRA, you may not be aware that you can actually refinance that property. So if you purchased a home 5 years ago, paid $100,000 for it, now it's say roughly worth $110,000. You want to buy another single-family home that you identified for $60,000. You could actually refinance that, take the equity, put the loan proceeds back into the IRA. You have that $60,000 in there, then you could pay cash for another property, or you could improve this property. So there's numerous options you can do once you refinance that home. So please keep that in mind if you already own property in your IRA. A question does come up a lot. Well, I own a property in my personal name. Can I transfer it to my IRA? And no, that's prohibited. So it does have to be a piece of real estate that you currently own in your IRA account. Eligible properties. We typically focus on residential property, so single-family homes, condos, townhomes, multifamily. Commercial, we don't see a whole lot of that, so we typically don't lend on commercial property unless, again, it is a very, very good situation. And the next slide, I think this is more important, is ineligible properties. We don't lend on raw land because you're not generating any cash flow to offset that mortgage payment. And then construction loans. We don't provide construction loans, but it is possible to buy a new construction home in your IRA. Most likely you'd have to have the builder front the funds to build the home. And then we could get involved and provide that permanent financing once it is 100% complete. So you look through the list here, these are just some of the riskier type of properties that banks tend to steer away from. So it's consistent with other forward style loans. What most banks, if they lend on them, I guess they're more cautious with these property types. Now we've talked about IRAs a lot. But we're also going to lend to any self-directed entity. So whether it's a self-directed IRA, a self-directed 401k, an LLC account where your IRA has purchased shares of the LLC, we'll also lend to that entity also. The guidelines are going to be the same. Basically, you're just taking title in a different manner, and we just have to collect different documentation. So all these are acceptable per our guidelines. And let's talk about cash flow requirements. So when you're buying real estate in your IRA, there's really three things a bank's going to look for. One is the property itself. Since it's the only collateral, we want to make sure that it's a satisfactory piece of collateral. Make sure it's in rentable condition, livable condition at the time of closing. Second thing are the reserves. We need to make sure that you have enough funds in your IRA for not only the down payment, but also some leftover reserves, because we've hit on that the IRA is responsible for all expenses. So if you move into that home, not physically move into it, but you purchase that home, then you're going to have a tenant in place from the very beginning, or you would have to have some reserves to supplement that home until you do get a tenant to move in. So along with expenses. So you want to make sure you have emergency funds built in up front. So we're going to verify that you have a minimum 10 to 20% of the loan size liquid funds available at the time of closing. And then the third thing is cash flow. Because they're investment properties, we're going to analyze them as such with a debt service coverage ratio formula. And I'll hit on this in a couple slides later, but we want to make sure that the property has positive cash flow. Because if it doesn't, then you're going to be depleting that IRA on a monthly basis. And we want to make sure that it's a good investment for both parties, and I mean the lender and the investor themselves. So let's discuss cash flow requirements. Now on the slide that's visible right now, it shows we require a minimum 20 to 25% positive cash flow on single-family homes, and then 25% plus on 2 to 4 units. So if we move to the next slide, we'll give a specific example. Let's say you're in Texas, you're looking for some properties with a real estate agent. You come across one for $125,000. Really like it, think it would be a good rental. There's potential with it. So you make an offer, seller accepts at $125,000. Now up front, you did your due diligence and ran some numbers, and the going market rent in that area is around $1,400 a month. So you multiply that times 12, and that gives you roughly $17,000 gross annual income that this property would produce. Now from our perspective, we're going to factor in all these expenses when we're computing the debt service coverage ratio, the DSCR. We're going to look at vacancy, which is 7% of the gross annual income of that $16,800. Real estate taxes, hazard insurance, and then maintenance and repair. We estimate around $400 a year that you have to spend, and then a management fee factor. We always build this in that you're going to hire a property manager to manage this property at 6%. Now that might be a little bit light. In most parts of the country, you're probably closer to 8 to 10%, but we're going to use 6%. So when you subtract out all those expenses, we get a net operating income for around $11,000 in this example. So now let's move to the next slide. And assuming you're getting an interest rate at 6% with putting $50,000 down. So you had a $125,000 purchase price, you're putting $50,000 down, your annual principal and interest payment is around $5,800 a year. So you divide that NOI by the annual P&I, principal and interest, you're going to get a 1.88 DSCR. Now on previous slide I mentioned we like to see between 20 and 25% positive cash flow on a single family home. So this example well exceeds that 20% threshold where 1.0 is the break-even mark. So at 1.88 we would look at this example and you know, as long as that property is good condition and we can verify it with an appraisal, the going market rents and the value, this would be a good scenario that we would lend on. Now one thing I will note that's a plus, when you're buying real estate within a self-directed IRA or any self-directed retirement plan, it's not going to show up on your credit report because it goes under the tax ID number of the entity on title. So that can be an advantage if you're an experienced investor and you own 10 plus properties. You know how hard it is to get conforming rates these days, where it's quite a challenge. So those loans will not show up on your credit report when you do buy them in your retirement plan. So that can be an advantage for you. And let's move to the next slide here. To give you an idea of costs, we do charge 1% origination fee, list the other fees there, underwriting, processing, and an appraisal fee. We do order an appraisal with rent comps and rent schedules. So you can see you're probably used to an appraisal around $300, $360, which is normal. And then there's an $150 charge the appraiser adds on for the rent comps and rent schedule. So we want to verify, if you're telling us $1,400 a month in rent, we want to make sure that's accurate or very close to that, where if it comes back at $900, then we definitely have an issue and our cash flow flow numbers would be skewed because $1,400 wouldn't be a reasonable rate that you would expect to get. So that's the only thing we require up front is the appraisal fee. We do escrow for taxes and insurance. We want to make sure that entity is in good standing. So we will collect principal, interest, tax, insurance payment, and we pay those when they come due. But again, your IRA is paying for them up front on a monthly basis in that payment. As far as how do you qualify for a non-recourse loan? I guess what's the first step? Basically, you would give us a call, speak with one of our representatives that focuses specifically on this product, and they would email you more documentation, a one-page form basically. You would fill it out on the property, submit it back to us. Then our loan committee will review that within 24 hours, and we can get you a pre-approval letter if you need one. So we'll analyze the information on the property and get back with you right away. So you can go into that offer knowing that as long as the appraisal comes back and we can verify your funds, you should be able to fund that transaction. The information can be found on IRALending.com, and this is just kind of a laundry list of items we're going to need from you to move forward to get the ball rolling with an IRA loan. On to the next slide. If you'd like more information, again, you can visit us at IRALending.com. We have a Facebook page, a LinkedIn group that has a lot of discussions on this topic. And Munzer hit on earlier, we do have a book out titled Leverage Your IRA. A good resource if you want to learn how to set up an IRA account, self-directed IRA, how do you get a non-recourse loan, what are some of the advantages, prohibited transactions, things like that. And then our blog page, there's lots of videos on there you can watch and learn about non-recourse loans and the ins and outs. So with that, that is the end of my presentation. I believe we're going to take questions at the very end, so I will now pass it back to Munzer for his portion.
Matt, thank you so much for this valuable information. This has been very educational. I'm sure our listeners out there will have a lot of questions for you, but I think we're going to take those, as you mentioned, right after my quick portion of this presentation. So again, Munzer Ghosheh here with the Entrust Group. I'm here to just give you a quick overview for those of you that are not familiar with the Entrust Group, who we are, what we do, touch up on what we call disqualified persons, prohibited transactions, some investment options, and a brief overview of plan types. The Entrust Group is the premier provider for self-directed retirement plans. For over 30 years, we've exclusively concentrated our services on the record keeping and administration of truly self-directed retirement plans, working with individuals and small businesses who want to take control of their own investment decisions when it comes to their retirement plans. We pride ourselves on our education program that we provide, whether it's through our continuing education program, our webinars, our live seminars, and our local offices throughout the country. Our staff is among the most knowledgeable in the industry, many of them holding the CISP, Certified IRA Services Professional designation, which is highly regarded in our industry. Oops. Let me go back. We currently have over 14,000 clients and nearly $2 billion in investment assets. Sorry about that. Okay. So there are many advantages to working with the Entrust Group. One of the main advantages of working with us is the local service that we provide to our clients through our many local offices nationwide. Our clients are accustomed to the superior local service and fast transaction times, both of which are pivotal in our industry. Having local offices also allow us to go out there to our communities and do presentations, whether they're for individuals or professionals such as CPAs, attorneys, and realtors. But what makes us unique is that we offer something that most traditional brokers cannot. You see, most of the retirement plans, actually over 95% of them, are held in institutions where you're restricted by what you can invest in, namely the traditional investments, the stocks, bonds, mutual funds, money markets, and etc. At the Entrust Group, we do not sell or promote any products. We just give you the maximum flexibility and control of your retirement plans. You make the investment choices. We provide the record keeping and administration for your plan. So what are the primary benefits of self-direction? It's basically more control and more choices. You are in control to make your own investment decisions and invest in assets you know and understand, rather than having someone else tell you what to invest in. So what are the investment choices offered within a truly self-directed retirement plan? The Internal Revenue Code 4975 actually lists very few investment restrictions, things that you cannot purchase within your retirement plan that we will cover next. So as you can imagine, our clients can get creative, and they do, pretty creative in their investment choices. Our clients at Entrust invest in over 50 different investment options. Here's a list of some of the more popular ones. Obviously, real estate is probably by far the most popular asset class. We have clients investing in single-family and multi-unit homes, whether they're apartments, condominiums, larger deals such as commercial properties, developed or undeveloped land. I would say that's one of the more popular. People purchasing raw land within their IRA and just hold it for appreciation. Foreign property. The misconception out there is you want to invest in the state that you live in. We have clients investing in nationwide. We have clients investing offshore. As long as you're aware of the rules and regulations of the country that you're investing in, we would allow you to do so. But as Matt mentioned, obviously that would have to be an all-cash deal, since I don't even know of any lenders that would lend you for offshore deals. Trust deeds, notes secured by real estate. We have clients investing in that as well. Leverage properties. Obviously, Matt spoke in great detail about that, and they use the power of leverage to invest in real estate. Precious metals. As you can imagine, that has become one of the more popular asset class. We actually have a precious metals center in Reno, Nevada, dedicated to servicing our metal clients with knowledgeable staff, providing superior customer service to our clients. You can invest in limited liability companies, limited partnerships, secured or unsecured loans. It could be secured by real estate, as we talked about, or secured by any other collateral. Unsecured, your IRA cannot lend money to yourself or anyone that's directly related to you. That's a prohibited transaction that we will talk about shortly. But we have a few clients that lend their money to anyone else, for that matter, at whatever rates and terms agreeable between the borrower and the lender, which is the IRA. And other exotic investments such as joint ventures and life settlements. So really, there's a lot of things that you can invest in within your retirement plan. There are very few investment restrictions. Again, as I mentioned, the Internal Revenue Code 4975 just lists very few of those. And it's namely collectibles, any work of art, rugs or antiques, metals or gems, with the exceptions of some minted gold or silver eagle, gold and palladium bullions, life insurance policies, and S-Corps. S-Corps IRAs cannot invest in. They may invest in C-Corps or LLCs, obviously, but not an S-Corp. So there are very few, again, investment restrictions. However, there are certain transactions, as opposed to investments, that are prohibited. And in order to better understand whether a transaction is prohibited, it's important to know who is considered a disqualified person. to the retirement plan first. Those are certain family members, I think Matt also touched up on them, that cannot do business with your IRA. Namely, direct family members, a spouse, parent, grandparents, children, grandchildren, spouses of lineal descendants, for instance, a son-in-law or a daughter-in-law. Those, the IRS says, cannot transact with your IRA and do any business with your IRA. More examples of disqualified persons. Again, the fiduciary to the IRA, including the IRA owner. So you're disqualified to your IRA. You cannot do any transactions with it. The employer of the employees covered by the plan, family members, obviously we discussed that. Anyone providing services to the plan, and others, obviously. We're just giving you a quick overview on who the disqualified persons are. For more information, please reference, again, the Internal Revenue Code 4975. So we mentioned previously the specific investments that are not allowed. Here's some of the transactions that are not allowed between the retirement plan and a disqualified person. These transactions are called prohibited transactions. So for instance, we're talking real estate here. So for instance, in the case of purchasing a real estate property, and again, Matt touched up on that a bit as well. You cannot buy, sell, or exchange between your IRA and disqualified person. So what does that mean? For example, my IRA cannot buy a property that my father already owns because he's disqualified. Or my IRA cannot sell a property to my son or daughter. You cannot provide goods and services. So if I'm purchasing a property in my IRA and my father is has a property management company, that company cannot manage the property that my IRA owns. Or if my son, for instance, is a contractor and I'm in the business of buying and rehabbing properties, then the property that my IRA buys cannot be rehabbed by my son's contracting company. You cannot use the property, and again, Matt talked about that as well, by any descendants, or any spouse of lineal descendant, not for a day, not for a week, not for any time as long as the IRA owns the property. So the general rule here is if you buy from a third party, rent from a third party, and eventually if you want to sell it to a third party, you should have no issues. So again, stay away from, there's no self-dealing, no personal use, and no personal benefit. So we talked about prohibited transactions, and again, for more information on that, please reference Internal Revenue Code 4975. But here's some examples of acceptable transactions. And Matt talked about partnering with others' IRAs or other persons. Another strategy that we're seeing are individuals partnering with themselves on a new deal. So your IRA is one entity, and you, as an individual, as another entity, can go into a partnership together to purchase a property. The key word here, new deal, meaning, again, a property that neither one of you already own or anyone else is disqualified already owns. Now there is, however, must be able to show that you can purchase this property outright without the use of IRA funds. Okay? Other acceptable transactions is partnering with your cousin. Well, again, the cousin is not a disqualified person. You can partner with him as an undivided interest, joint tenants, to purchase a property. Partnering with your spouse on a new deal. Again, the spouse is a disqualified person, so you need to go in on an investment that is a new investment. Leasing a property to the siblings. As you notice from the list of disqualified persons, siblings are not considered disqualified. I would caution that, and I would be careful when I'm working or dealing with my sibling when it comes to my retirement plan. For instance, if I want to lease it to a brother, you want to make sure that you're leasing it at fair market values as far as rentals and so on. So plan types. Again, we're just going to really touch up on this very, very quickly on a quick overview of what plan types can be self-directed. We're not going to spend a lot of time on this as we have webinars specific to the different plan types, what they are, the contribution limits, and what have you. But the one thing that I want to make sure that everyone is aware of, that all types of plans can be self-directed. Whether you have a traditional IRA at Schwab or Fidelity, you can transfer it over to Entrust. Now you have a self-directed IRA. Whether you have a Roth IRA at B of A, now you can transfer it over to the Entrust group, and now you have a self-directed IRA. Whether you have employee-sponsored plans, such as Individual K or SEP and Simple, and other special plans such as the Educational Coverdale or Health Savings Account, all of these can be self-directed. One of the questions that we always common questions is, what about a 401k plan or a pension plan? For the most part, if it's a previous 401k, for instance, from your previous employer, those can be rolled over into an Entrust IRA account. If you're still employed and you're currently contributing to this pension plan or 401k plan, chances are your employer, unless they have self-direction incorporated in it, will not allow you to roll that over. I would say it's a case-by-case. Consult with your HR first and your administrator and see if it's possible to roll maybe a portion of it. But for the most part, when it comes to 401ks, 403bs, 457 plans, defined benefit plans, what have you, we are talking about previous employers. So 3 easy steps to get started towards your financial freedom. One is open up an Entrust account. Simple paperwork, takes about 24 to 48 hours once we receive the whole set of complete paperwork from you to set up the account and open it up for you. Funding your account, that normally takes about, it depends. You're either doing a transfer from an IRA or a rollover from a previous 401k plan. Industry standard is anywhere between 10 days up to 3 weeks. Since we have no control on how long it takes your other institution to go ahead and transfer and or roll over your funds over to us. Then you're ready to go out there and purchase the investment. In the case of real estate, to identify the property you want to invest, purchase. The purchase agreement, as Matt touched up on again, is in the name of the IRA, namely the Entrust Group, for the benefit of John Doe, IRA number so-and-so. That's signed by Entrust. Any earnest deposit will be paid by your IRA. Escrow is open in the name of your retirement plan. All the escrow documents come back to us. We sign the escrow, we fund escrow, we close it, and now your IRA owns the property. It's really that simple. So where can you learn more about self-directed retirement accounts? Well, you can schedule a meeting with one of your local offices. You can sign up for our local live seminars. You can visit our brand new website for a wealth of information, whether it's free reports, So this concludes my portion of this presentation. I hope that you found the material to be educational, informative. If you'd like to call me or email me with any questions, here's our information. Speaking of questions, let's see if we have any over here. Okay. Louise is asking here, can I live? Let's see. Can I live in my property after 5 years? Matt.
You personally can't live in the property if you own it in your retirement plan. Some investors will buy a piece of real estate in their IRA account and then transfer title from their IRA to their personal name, and if pay the taxes if they apply at that time if it is a traditional IRA, and then they could live in it. But at no point in time can you live in the property if you own it in a self-directed plan.
You? Okay, another question from Bill. Is there any current year tax implications when leveraging your IRA to purchase rental property?
Yes, there is. There is a tax called DBIT, unrelated business income tax, and it's not the easiest thing to explain over the phone. I recommend contacting a CPA, or our book does a good job of explaining UBIT. But a portion of the leverage portion of the transaction can be applicable to the unrelated business income tax, and there's a formula how they you calculate that. And in most cases, it may not apply, or it'd be very minimal. I recommend on our website we discuss that in more detail. I know the UBIT, again, we're not tax advisors, but again, UBIT can apply based on the portion that you leverage. Now, if you own property in your self-directed 401k, UBIT does not apply, or if you purchase the property outright, it also doesn't apply.
Mm-hmm. Thank you, Matt.
Mm-hmm.
Daryl has several questions. I think you covered the first question, but the question is, can you personally do work on property, repairs, management, etc., as long as the IRA is not paying you for this service, labor, and you are therefore not benefiting?
Well, the rule of thumb is no, you're not supposed to improve the property yourself. Munzer, you might want to answer that because it's kind of a gray area as far as I've heard some people say, well, if you're not adding value, then that's okay. But I think it's best if, as an Entrust employee, you lay out the foundation for what you would require.
Absolutely. I mean, the short answer is absolutely not. You don't want any work. You want to stay away from that property, and no self-dealing, and just have someone else, a third party, a non-disqualified person, do any management or repairs to the property. Now, the question sometimes arises is, I don't want a property manager. Is that a requirement? The answer is no. You don't have to have one. But if you decide to have one, then it has to be a third party, a non-disqualified party. So if my IRA is purchasing just a single family, and what is the extent of the property management? I mean, you could just let the tenant know to just write the checks, obviously to the Entrust group for the benefit of your IRA name and number. Either send it to you and then you forward it to us, or send it to us directly, but obviously not paid to you, or cash. And then let's say if you have any repairs, the tenant can call you, the IRA holder, and say, well, I have an issue, a plumbing problem. Obviously, you cannot go, or you probably don't want to go to fix it, but you cannot go to fix it. It's okay to pick up the yellow pages and find someone and direct them to your place and get it fixed, and obviously send us the invoice so we can go ahead and pay it out of your IRA account. But yeah, you want to stay away from personally doing any work, whether you get paid or not on it. The other question is, any North American Savings Bank lending concerns for Oregon?
No, at this time, we don't have any concerns in the Oregon area. Again, we look at each property case by case. So if a specific property doesn't meet our cash flow requirements or is in subpar condition, sure, we're going to have some concern. But the state as a whole, no, we're definitely lending in Oregon.
Mm-hmm. Yeah. Well, we're seeing a lot of questions, so I'm guessing it's a very intriguing concept and for everyone out there, and we'll try to cover as much as we can before the top of the hour here. Another question for you, Matt, is in February I was emailed that you were no longer doing refinancing if North American Savings Bank isn't the current lien holder. I'm curious to know why you stopped refinancing properties already owned by the IRA, then why you started again. Does this happen frequently?
Well, the bank did back in February. If you currently have a loan with North American Savings Bank, we don't have a modification or refinance option. This isn't something that changes frequently. No, that's not the case. It's just the costs associated with and other variables. The bank doesn't allow for a refinance or modification. Now, I did mention earlier that if you own property in your IRA, then we can offer a refinance if you don't currently have a loan on it, or if you have a loan with another lender, a hard money loan, let's say, we could refinance that with the North American Savings Bank loan.
Mm-hmm. Thank you, Matt. Charles is asking if I have a traditional IRA in a bank not associated with the employer, or an employer want to change it to a Roth. So I guess Charles is, and I'll be happy to answer that. I guess your question, Charles, is I have a traditional IRA. Now I want to change it to a Roth, and obviously the answer is the term here is converting it. Yes, you will transfer. A traditional IRA is a pre-tax retirement plan, so it has to move into a pre-tax another traditional IRA with us, and then we would set up another account for you to convert that to a Roth, and then basically obviously close up the traditional account for you. But it has to be done in a two-step process, traditional to traditional, then converted. Obviously, anytime a conversion occurs, you're dealt with, there's a taxable, triggers a taxable event that obviously you want to consult with your CPA here, as we do not give any sort of advice, including tax advice. So be aware that when you do convert from a traditional to a Roth, you are going to be paying the taxes on the portion that is converted. Mm-hmm. Paul is asking, can hire yourself for the property manager? I think we both touched up on that, but Matt, any other comments on that?
No, I mean, I think we've covered that we typically see our borrowers hire a property manager just to help with, the ease of owning investment property in their IRA. It's something that's not a requirement on our end, but most investors do get a property manager. Mm-hmm. Mm-hmm.
Darcy is asking, in your example, Matt, of whether NASB would provide the loan. You have an example of $75,000 loan at 6%. Mm-hmm. Is this an old example, or do your loans carry a higher interest rate?
I mentioned the rates earlier, and that's we offer rates from 5.875 up to the low 7s. Just depends on the amortization and the property type. So I mean that is in our range of what we currently offer. With non-recourse loans, they are going to be higher than conventional conforming rates, and that's because we hold these 100% in our own portfolio. It is a niche product. They are non-recourse. So regardless of what lender you use, you can expect for non-recourse loans to be a little bit higher just because of those reasons.
Mm-hmm. Mm-hmm. Let's see. I think we have time for a couple more questions. And again, okay. If we cannot, obviously we're not going to be able to cover all these questions for you, but feel free to either call me or call Matt. If it's specific to North American Savings Bank, obviously call Matt directly. Or if it's specific to IRA questions, to call or email me, and you have our information on the screen there with any other questions. Terry is asking, can you assign, Ross is asking, do you know the rules for transferring a home to yourself after you reach retirement age? Basically, the retirement age is there's two ages that you want to be thinking about. Is a normal distribution, which is 59.5, which means you may start to take distributions, or at age 70.5, there's what we call the RMD, required minimum distributions. I think you're talking about when you reach retirement age of 59.5 and you wish to live in that property. Now, we mentioned as long as the property is owned by the IRA, you may not live in it, but you could take it out as an in-kind distribution and deed it to yourself, at which point you will pay the applicable, obviously, taxes, and now deed it to yourself at whatever fair market value the property is at that point. Matt, do you have any comments on that?
I think just one other thing to add. 59.5 you mentioned is the earliest age. You can start taking it out without having to pay that extra tax that can apply. Now, traditional IRAs where it's 70.5, you're required to start taking out a minimum distribution. Where if it's a Roth IRA, it doesn't have that minimum age requirement. So I think that's important to note.
That's very important. Thanks for bringing that up, Matt. Yeah, RMDs are only applicable to pre-tax traditional IRAs. Fred has a question: can I have a single-family home built for resale using my self-directed IRA and then leverage with a loan?
Yeah, well, I guess I will say that we lend looking at properties as long-term rental holds where there's no prepayment penalty. So if you were to build a home and then you were wanting to resell it, there's no penalty to pay that off early. But we're analyzing these properties as long-term investments instead of flips. So it is allowable, but again, we're looking at the cash flow that you're going to hold this for minimum 12 months, something to that effect. So we see this occasionally, but most of our lending is done on long-term instead of short-term holds.
James has an interesting question. If I own a property, sell it to a qualified third party, someone that's not disqualified, and once that party is rentable, can it then be sold to the IRA? And if so, is there a seasoning period? I think the question you're asking, James, is can I basically, I own the property now, sell it to someone else that's not related, and then my IRA buys it later on? The short answer is no. The IRS has that covered as well through, I think it's called the indirect rule. Anything that you cannot do directly, you may not do indirectly as well. So I would they have that covered. I would stick to purchasing properties that are new, meaning that you've never owned. Seasoning period, I don't know if there is any, but I would, I would stay away from purchasing, having my IRA buy a property that at any time I've owned. Matt, do you have any comments on that?
Yeah, I would just reiterate that the IRS is going to look at it as linking. If you already own a home in your personal name and then you sell it and then your IRA buys it back, that is something you shouldn't do. Just avoid that. If you've ever owned the real estate personally, just know that you shouldn't be putting it into your IRA.
Yes. It is right at 11 o'clock. I'm going to take one more question and then, again, ask you, and again, I do thank our listeners for all the questions that they've posed here today. Again, feel free to either call or email me directly with any IRA questions, any lending questions. Again, call or email Matt. With those, we'll be happy to answer them for you. Bruce's last question is, are the 20-year fixed loans you discussed amortized over 20 or 30 years?
The 20-year fix is going to be amortized over 20 years, excuse me. A 25-year fix will be amortized over 25 years. So it is a true amortization based on the fixed product itself, where if it's a 5-year ARM, that could be amortized over 15, 20, or 25 years.
Okay, great. Well, again, I think those were great questions. As I can see from our chat box, we had many more that I'm sorry we weren't able to cover. If that tells us something, that tells us that a lot of people out there are interested in this concept, the power of leveraging your IRA. Again, for any other questions or concerns, please either call or email me directly or Matt Allen at North American Savings Bank. I once again want to thank Matt Allen for joining me today, educating us all on how to leverage your IRA to purchase real estate. That was very, very interesting. Thank you, Matt.
Thank you for having me on.
Absolutely. And thank you all for joining us. I hope everyone enjoyed today's webinar. We hope that you can join us in one of our upcoming webinars. Thank you so much.
Thank you. Please stand by.